ICT to other financial to handle financial aspects as well. So it helps to learn to the projects we are having. We should be able to do it the right way. So it's
Okay.
very helpful. Thank
Great,
you, ma'am.
great, great. Okay, so let's start this class. Today I'll be starting with fund flows. Now, are you able to see my screen? Are you able to see my
Yes.
screen? So, okay. So in the previous class, we have studied how to prepare cash flow statement, and we also learned why it is important. So as we have already discussed that if you go through the balance sheet or financial report, you'll be able to know position, but not enough. That is not enough. If I know that my cash position is negative or my cash position is positive, that may not be enough. Then the next question will arise in your mind: why my position is positive? Why my cash position is negative? So that is why cash flow statement is being prepared by the managers in the business organization so that they can understand within the cash transaction or the major transactions what balance whatever is reflecting in the balance sheet different journey, how much money has been given from which sources, it is been borrowed, and where it has been spent. All right. So here we have prepared the cash flow statement. Now the second one which we are going to study today is a fund flow statement. Is how cash and funds are different. All right. Now I am going to give you a very simple example. Let's say right now someone is asking me how much. So I have just opened my wallet, checked my money, and said that I have 1000 rupees in my pocket or in my wallet. All right. Then again the person asked, how much cash altogether do you have? Again I have opened my passbook of bank. I came to know that there is 5000 rupees in my bank account, and as my wallet is containing 1000, so therefore I said my cash is altogether 6000 rupees. All right. So this is about the cash. Now, if someone understands that I do have 1000 rupees in my wallet, what is the information? The information is right now as liquid money I do have 1000, but it is not reflecting my financial position. It is just telling or stating you that this much of money right now I do have to meet my expenditure, immediate expenditure. But if someone asks me, how much fund do you have? Then I need to again start calculating. Okay, in my pocket I have 1000 rupees. Jewelry. Additionally, I have a house or a home which I can sell out. That is my property. Additionally, I have invested in shares. Additionally, maybe I have kept some FDs. So my all assets, including the cash that I do have. Now, if someone asks me, what is your financial position? Actually, instead of cash, I must tell the total of asset or investment I do have. So fund is not only about cash. Fund means the all the assets owned by the organization. Of course, when you are calculating all the assets of the organization, you should always try to deduct all the debts or all the liabilities the organization do have. So you can say fund means all the assets after deducting the value of the liabilities. Okay, so that is the explanation of fund. So you can understand only by calculating the total fund, we can understand the financial position of a company. Cash flow only explains how much liquidity do you have. Means if certain expenditure or certain emergency occurs, how much liquid money do you have, that the cash flow statement can explain. And how much you can still bring by selling out your assets, or what is the opportunity to next sell the product or assets you do have, that the cash flow statement can explain. Just this was the cash flow statement we have prepared earlier. So we can see if further cash is needed, we can always say that we can issue some share capital and still we have some building and machinery which can be sold out. Okay, and cash can be also generated by selling out the stock because we have stock in our hand. So these are the explanation for cash flow. Now fund flow means the all the assets you do have in the business and all the other ways from which you can earn money, whether it is debt fund, whether it is equity fund, whether it is any other sources. So understand more about fund flow statement, I have again taken a balance sheet. Now this is a balance sheet of 2 consecutive years in your screen. Let's read out the balance sheet. From the following balance sheet, a limited company as at 31st March 2016. Oh, sorry, this is going to be misprint. It is 16 and 17 going to be, sorry. There, that must be a typing error. So from the following balance sheet of a limited company as at 31st March 2016 and 2017 were as follows. And this is the balance sheet. All right. Now with this balance sheet, you are supposed to prepare the fund flow statement. Means how much fund do you have and how much you have spent in which heads, that you need to prepare from this balance sheet. And of course, whenever you are preparing the fund flow statement or cash flow statement, you must take consecutive 2 years balance sheet. All right, because you need to compare your previous year to present year's financial position or fund position. So here we have taken the data of 2016 and 2017. So how to prepare the fund flow statement? Before preparation of the fund flow statement, the first thing that you need to calculate is working capital. And what is the formula for working capital? The working capital formula is current assets minus current liabilities. Okay, so that is the formula. So here in the liabilities section, number 4 is the heading for current liabilities. Under current liabilities, we have two items, trade payable and proposed dividend. All right. So these two are the current liabilities we do have in this particular question. Now, talking about the current assets, there is no heading, but we can see that stock, debtor, and cash. These three are the items which lies under current assets. What is the definition of current liabilities and current assets? These are the short-term assets and short-term liabilities. Current assets means all the assets which we generally use within the financial year. Current liabilities means all the liabilities which we need to pay within the financial year. So these assets and liabilities are not going to exceed more than 1 year. So the first calculation before preparation of fund flow statement, always we need to prepare the working capital. And the formula for working capital is current assets minus total of current assets minus total of current liabilities. All right. And after that only we can prepare the fund flow statement. So we can say these are the two steps. In the first step, we need to calculate the working capital, and in the step 2 we need to prepare the fund flow statement. Okay, so these are the two steps. Now how to prepare? For that you need to uh, write a This is the format for calculation of working capital. How to calculate? First, you need to write down the amounts which are available. So you can see this is the heading, statement showing changes in working capital, that you need to write in the beginning. This is the heading. Now you have a particular section where the items will be reflected. Now we also have 31st March 2016 and 31st March 2017. What it means? It means that uh, we need to write down all the values of those particular years here. And here again one more section is there, that is increase and decrease. Now this increase and decrease talks about how much value from the previous year to this year has been increased or decreased. So my first job is to note down the current assets. So here I can see there are three current assets, that is stock, debtor and cash. So I am just going to copy these three items here. Stock, debtor and cash. I have these three current assets in this particular question. Now I need to see the value in the 2016. So these three are the value available in 2016. Okay, again I would see the value of 2017, and these are the value of 2017. Now once I noted down both, now I can easily identify in the 2016 the stock was 25,000, and in 2017 it is increased by 10,000, that is why it becomes 35,000. So in the increase section I am mentioning by how much it is increased, it is by 10,000. Similarly, debtors, earlier it was 28,000, now it is 30,000, means it is increased by 2,000. And the last one is cash. So earlier it was 2000, now it is 2500. So again the increase of 500 rupees. Now once you have noted down all the current assets of 16 and 17, mention the increase and decrease. The next step is calculate the total. So 0, 0, 0, 8 plus 5, 13, plus 2, 15. So 5, 2, 2, 4 and 1, 5. So this is the total, 55,000 is the total of current assets in 2016. Now I am taking the total of 17. So this is 5. Now 3 plus 2, 5 and 5, 10 and 3, 4. So 40,500. This is the total. Okay, so after writing the total of current assets, now the second section which I do have, that is the current liabilities. Now under the current liabilities, I have two items, trade payable and proposed dividend. So let me copy these two items, trade payable and proposed dividend. Uh, Oh, sorry. Here I will take only one. Proposed dividend will go with shares. Sorry. So I am taking trade payable 45,000 and 50. So here you need to understand that dividend always goes with the share. So that's why I have not taken it here. Okay.
Excuse me,
So
ma'am.
yes, please.
The figure in the 2017 is supposed to be 67,500, not 40,500.
All right. All right. Sorry. Sorry. 5 plus 2, 7. Sorry. 5 plus 2, 7 and 3 plus 3, 6. So sorry. 67,500. Thank you for making me correct. Thank you.
You're welcome.
So now this is the total, 45,000 and 52,500. Only one item, so no need to total. This is the only total. Now you need to understand, when we are writing here, if we can see again from 16 to 17, according to our observation, you feel that it is increasing. But always liability we write in the decrease side. Why we write it in the decrease side? Because fund is going to be reduced if the liabilities are increasing, because in a near future within the financial year you need to again repay that amount. So if your liabilities are increasing, don't treat it as increase, rather vice versa, for the liability you put it in the decrease side, and if your observation says it is decreasing, then you need to write it in the increase side. Always remember the liabilities entries are in the vice versa side. Okay, So right now I am writing the minus figure 7, 8, 9, 10, 11, 12. So 7,500. Okay. So this is the decrease. Okay. Now once we have done, now the formula for working capital, as I said, it is current assets minus current liabilities. This is the formula of working capital, current liabilities. Now we have the 2016's current assets and 2016's current liability. So 55,000 is the total asset, current assets, and 45,000 is the total current liability. So working capital would be 55,000 minus 45,000, that is 10,000 rupees. Okay. Similarly, in the year 2017, we need to again minus and see how much is the working capital. Okay, so 5 and 1, it is 15,000. Okay, so working capital for the year 16 was 10,000, and in the 17 it was 15,000. Now here we can again observe these two figures and we identify that in the year 2016 the requirement of working capital was only 10,000. That means by investing 10,000 rupees the company was able to run the business successfully. But in the 2017 more money has been required, and it how much more is required, that is 5,000 rupees. So that is why here the interpretation is increase in working capital. It could be decrease in working capital if the figure suggested that too. So 10,000 so to 8,000 would be decrease in working capital. Here I can identify it is a increase in working capital. I have written it here. Okay, why I have written it here, so that I can match the total. Why it is needed to match the total? Just to ensure that there is no calculation error. So 10,000 plus 5,000 is 15,000 and 15,000. Just to match the figure, no need otherwise. So we can identify this is actually the outcome. We need to focus that we have received that increase in working capital by 5,000. Further, you would like, if you would like to match the figure here also, it is increase in working capital. Write this 5,000 in a vice versa side, 5,000, just to ensure your totals are correct or not, your calculations are correct or not. You can also make the total of these two sections and it will be equal automatically. So 10 plus 2 is 12,500, so it is 12,500. And here 7 plus 5 is 12,500. This is not needed for the purpose of calculation, only this ensures that your totals are correct. Okay, so after preparation of working capital, we able to know that there is an increase of 5,000 more in the working capital section. Once we have prepared this step 1, now step 2 is to prepare the fund flow statement. Now for fund flow statement, this is the format, or the simplest format you need to draw. That is, you need to write fund flow statement at the top, and left hand section is the sources of fund, means all the sources from where you are borrowing the money or bringing the money in the organization. In the right hand side, you need to write down or jot down all the applications of funds, means where you must spend the money. And of course the total is going to be equal, because whatever the money you do have, you can spend actually that amount. It may not be more, or it should not be less than that. So we will start with this. The 5,000 increase in working capital means you are investing more than the previous year, and that amount, how much more you are spending? You are spending 5,000 more as capital. So this 5,000 more spending is your application of fund for 2017, because this fund flow statement which I am preparing, it is for the present year 2017. So starting with increase in working capital. So this is 5,000. Why this is application? Because previously I have managed with only 10,000 rupees. Right now I need 5,000 extra. So 5,000 I need to apply as investment, as capital into the business. So this is the outcome of your working capital. And by writing this, you also ensures that these sections we have already dealt with. current liabilities and current assets. This we don't need to write again because we have already put these items under working capital, and the outcome I have already written in the fund flow statement. But rather than whatsoever is available here, I need to identify what is a sources of fund or application of fund, and according to that I need to enter into the fund flow statement. Starting with the first option, that is share capital. So this is the first option and it is not a part of working capital. So I need to see that what I can see is that in the year 2016, the share capital was 50,000 and in the 17 it is 60,000. That means in the year 2016, 50,000 are being received by issuing the shares. But again, if you look at the figure at 17, it becomes 60,000. That means you have issued more shares into the market and received more share capital. So that is a source of fund. You have received 10,000 extra in the year 2017. So I can write it as a source that issue of shares and the amount is rupees 10,000. So I have earned 10,000 rupees by issuing shares in the year 2017. This is my source of money. Now general reserve. Look at the general reserve. Earlier the reserve fund was 20,000. Now it is 25,000. Because what we have done is we have in general reserve. So this is a fund and fund is growing. So by how much it is growing? Let me check once. I forget. It is by 5,000. All right. So I will mention here 5,000 rupees. Okay. Now after this, I need to look at the third item. This is the statement of PL, profit. Okay. Now 2,500. That means 2,500 has been earned in the year 17. So another source of fund. Now statement of PL, we don't write it as statement of PL. The term we use here is fund from operation. It is PL, but we do not use the term PL. We use fund from operation. You need to remember it. 2,500. Fund profit means profit. Okay. Now third item is over. Now the fourth item is 12% debenture and there is no change. It is neither increase or decrease. So no need to mention anything. Now under the current liabilities, trade payable we have already mentioned under working capital. So no need to mention it again. But proposed dividend, we can see earlier we have given 5,000 as dividend and now I am going to give 7,500 as dividend. So I am paying more. Okay, I am paying more. 2,500 I am paying more. So it is a application of fund, but in future, right now this is just like a fund, it is available with me. So more 2,500 is available because it is proposed dividend, you have not yet paid. So the amount is available within the organization, so that's why you need to write it here. And now after that you just look at the figures which are available under assets. Here we can see fixed assets 80,000 to 92,500. So that means your fixed assets are increasing. And if fixed assets are increasing, that means you are purchasing, you are buying no more fixed assets. And it leads to the application of fund. You are using your money to buy more assets. How much more you have purchased? 92,500 minus 80,000. That is 12,500. All right. So here I am mentioning purchase of fixed assets 12,500. Now after that, one more item is there long term investment. So earlier the investment was 2000, right now it is 22,500. Then it is also application. You are investing more money in the projects. So 2,500 is again the application. Okay. So long term investment 2,500. Okay. Now I think I forget to write proposed dividend. So proposed dividend means the money that you do have right now with you to pay the dividend. But as you have not paid, for now it is the source. So earlier we have 5,000 rupees to pay. Right now we have 2,500. That means we have 2,500 rupees extra as source. So here I am mentioning increase in proposed dividend by 2,500. Now, now you look at the figure. What are the sources of fund from where I get money? I have issued a share of 10,000. The general reserve containing increased 5,000 amount. From profit, I earned 2,500 rupees, and proposed dividend, which is not yet paid, 2,500 rupees is still with the organization. These all are the sources of money. And where you have spent, you have taken 5,000 as working capital. You have purchased more products and you have invested 2,500 in the year 2017. Now if your calculation is correct, that means you are going to get the similar total in both the sides. If your calculation is wrong or you are not covering up the entire balance sheet, then your total is going to be wrong here. That means you need to again revisit the balance sheet, and again you need to identify where you have missed. So I am just totaling the right hand side, that is the application side. 5,000 plus 12,500 plus 2,500. So the total is 20,000 in the application side. Now I need to see that is it the same in the source side or not. So again I am making the total 10,000 plus 5,000 plus 2,500 plus 2,500, and see the total is equal. It ensures that you have covered the entire balance sheet. The first section is working capital, where you have taken all the current assets and liabilities very efficiently, and the outcome is located in the fund flow statement, and rest of items you identified correctly and put it into the correct place. That is why your total in both the sides are equal, and you need to underline always the total with double lines. Okay, so this is how you need to prepare the fund flow statement. It is a two-step account. It is a two steps account, and the outlook of your account is like this. All right. You can take a screenshot just to uh, further in future for your references, like how far fund flow statement are prepared. I think you will get a question in your assignment from how to prepare fund flow statement, or maybe one practical balance sheet will be given and you need to calculate the fund flow statement. So it is going to be a mandate question in your assignment, hope so. In general, fund flow statements are a part of assignment. So this is how you can prepare. Any question? Any question?
No question, ma. This is very
No
understandable.
question.
Yes,
Okay.
ma.
Anyone else? Any query or question? No question? You can ask freely. This is going to be our last class of this particular paper. So I request everyone to ask question if you have any doubt. No question for now. Okay, fine. All right. Now, if there is no question, I would like to move further and I would like to focus on the next part. This is the last part which I have not dealt with. That is the capital budgeting part. Okay. So, what is capital budgeting? Till the date we have studied that capital are of two types. One is long term capital and another one is short term capital. Short term capital is also known as working capital. Short term capital, the definition of working capital says that the money which is required to meet the daily expenses or the expenses which occur in the within the financial year. So here short term means one financial year, that is the maximum period. So within the financial year, whatever the requirement of capital, that is known as working capital. And here we also get to know how to calculate the working capital. So this is the method of calculation of working capital. Now for this working capital, you won't get any public funding. So for the business, you need to manage your working capital on your own, either from your own resources, or you can borrow it from the lender, or you can borrow it from bank, the short term loans, or you need to manage it with credit. Okay, so but public money like the shareholders are not going to help you, debenture holders are not going to help you, because it's a government mandate that you cannot ask for the working capital from the shareholders. You cannot issue shares to meet your daily expenses. So working capital, the owner has to manage from their own fund, whether that is a fund of business, the fund of personal, or maybe they're managing it with credit. Now, the second part of capital is the long term capital, which is required in the business for the establishment, like for buying raw material, for buying building, furniture, or any long term assets. Okay. Now, for that, you are allowed to take the public money in form of shares or debentures, or you can also use your retained earning, a part of your profit, or maybe you can also borrow money from bank or any financial institution. Okay, so that is all about the need of capital and how it is being managed. So long term capital is for more than 1 year. It can be for 2 years, it can be for 20 years, it can be for 200 years. Okay, now these are the sources of capital. Now the question is, when the company is getting the public money, it is the duty of financial manager to effectively use that money into the business. And for that, the manager has to be very sure where that money is being invested. Okay, so let's say there are two, three options. Then the financial manager has to choose wisely which project or which option is beneficial, because the money is limited. So you cannot take any risk. So you need to analyze the risk and return. And then only if you see that there's a minimum risk and maximum return, only on that case you can invest. Now, if there are two, three projects, you need to calculate where you will be getting more profit and your investment should go there. So that is all about capital budgeting. Means whatever the money you do have, with that money you need to wisely choose the project which is going to be beneficial for you. So capital budgeting means the budget. It is a budgeting method for your money which is being invested in the business. All right, so let's say one company is having 2 lakh rupees as capital. So the financial manager's job is to identify the project where 2 lakh rupees can be invested and you may get the maximum benefit. Okay, now talking about the procedure of capital budgeting, there are actually 4 procedures of calculation under capital budgeting, so that we are going to discuss one after another. The first one is the first one is payback period method. The second one is accounting rate of return method. The third one is net present value method. Okay, and the fourth one is sorry, internal rate of return method. These are the four methods of capital budgeting by which the financial managers generally evaluate which project is going to be beneficial. So of course with the name itself you can understand that here generally we compare more than one project and we try to identify by the logic of payback period method or by the logic of accounting rate of return method or by the logic of NPV or IRR which project is going to be beneficial. So here after this I am going to discuss each method of evaluation of project, starting with the first one, that is the payback period method. Now to understand what is payback period method, just I am giving you one example. Let's say that I have purchased a machine, okay, and with that I have purchased a sewing machine, and with that sewing machine I am going to stitch clothes, and I am going to sell out those clothes in the market and going to earn money. So if that is the proposal, let's identify. Let's say I have purchased that machine in 5,000 rupees, and I am expecting that every year I am going to earn 2,000 rupees by selling out the clothes, by preparing the clothes and selling out into the market. That means first year I can earn only 2,000 rupees, which is less than my invested amount. In the next year, again I am going to earn another 2,000 rupees, still it is less than the invested amount. And in the third year, after 6 months, I will say that I have invested 5,000 and that 5,000 rupees is recovered. So payback period method says that whenever you are taking out a project, the first thing you should always calculate that when your investment is going to come back to you. If it is coming back sooner, that project should be accepted. That means, let's say if I have two projects and both the projects I have invested 5,000, I need to identify in which project I will get my 5,000 back soon, and that project has to be accepted because at least I have no loss as my investment is coming back to me. Okay, with this logic I am going to show you one question of payback period method which will give you more clarity. Now if you go through this question says Rohit Limited is considering to purchase a machine. Now he has two choices, machine A and machine B, and these two are available, both are available at a cost of rupees 1,20,000 rupees. Now which machine Rohit should buy, because the cost of both the machines are same. And then here are some declaration that the expected income from machine A in the first year is 5,000, in the second year is 40,000, and so on. So 5 years earning from machine A and 5 years earning from machine B is given, and you need to examine the alternative machines by payback period. Which one is going to be beneficial? As I said, that payback period method says where you are getting return your investment sooner should be always given the priority. So how to calculate? It is easier for you, but still, and I would just like to show you how the calculation takes place. So if this is the calculation, I am just going to copy this question. Okay, so there may be some issues with my file. So trying to prepare a table. So I will take a table 1, 2, 3, 4, 5. In the first, I will also write year. In the second is cash flow statement. So yearly cash flow. machine A. Okay, so here I can see that these are the years available and these are the cash flows available. The last column is not needed even. Okay, so after this I need to calculate the cumulative cash flow. Okay, cumulative cash flow. Now, how to calculate the cumulative cash flow? The first year my earning is 50,000. At the end of second year, my earning is going to be 50,000 plus 40,000, which is 90,000. In the next year, my earning is 30,000. So 90 plus 30 is 1,20,000. And after fourth year, 1,20,000 plus 20, 1,40,000. And at the end, another 20,000. So 1,60,000. Okay, so this is my cumulative cash flow, and I, as my investment was 1,20,000, so I can see in the third year I am getting my invested amount back. Okay, so I can say that pay back period of machine A is 3 years. Now I'll be taking the machine B and I will see what is the scenario. So here I am taking machine B and I will also calculate the cumulative for machine B. Now let's again take the values from here. Okay. Now in the first year the earning was 20,000. In the next year 20 plus 30, therefore 50,000. Third year 50,000 plus 50,000 is 1 lakh. In the next year 1,40,000, and in the last year 1,80,000. Okay, now look at the figure. In the third year I am not getting my investment back. I am getting at the end of the fourth year I am getting more than my investment. So my payback period will lie in between third year and fourth year. Somewhere in between this my payback period is going to lie. So it will be 3 years, but not exactly 4 years. It will be 3 years few months. So if it is the situation, how to calculate the payback period? So I'll see payback period of machine B will be definitely 3 years plus in the fourth year. What I need to calculate in the fourth year, we have instead of 1,20,000 I am earning 1,40,000. That means I am earning 20,000 extra. So 20,000 at the above, and at below I will write the entire earning of fourth year. This is the formula. So in the at the top you need to write how much extra you are earning at the end of the year. At the bottom you are writing how much was the earning of that particular year, that is 40,000, and you multiply it by 12 so that you can calculate the month. So if you calculate 20 by 40 into 12, so 20,000 divided by 40,000 multiplied by 12 will say 6. That means actually the answer is going to be 3 years and 6 months. So the interpretation is machine A is giving me back my investment in 3 years and machine B is taking 3 years 6 months. So according to payback period, you need to write the interpretation according to payback period machine A should be purchased as because it has a lesser payback period. So this is all about payback period calculation. So payback period suggests where the investment you are getting back sooner should be accepted. Now there is one more method in the question. They have asked that post payback period means you need to see after the payback period how much years are left with you and how much earning is left with you. Again, starting with machine A, you can see that machine A is returning your investment in the third year. That means in the fourth year you have started earning profit, and in the fifth year also you have started earning profit. So in fourth year plus fifth year you are earning profit. How much you are earning? You are earning rupees 40,000 altogether. Okay, so that is post payback period for machine A. Okay, here I am also writing the heading post payback period and earning. If this is the heading, machine A's post payback period is 2 years, because another 2 years machine A is going to give us earning, and how much earning it will give? It will give 40,000 rupees. Now let's talk about machine B. So machine B is returning the investment in 3 years and 6 months. And if the total year is 5, that means the post payback period is going to be another 1 year and 6 months out of 5 years. And how much would be the earning? This 40,000 entirely will be post, but this 40,000 in the fourth year will be divided into pre and post, 50 and 50. So we can say the 6 months earning is 20,000 here in the fourth year, and the rest fifth year's earning is with machine B would be completely the profit. So 20,000 plus 40,000. So post payback period earning is 60,000. Now you compare again these two post payback period machines. Machine A is going to run another 2 years and going to generate 40,000 rupees only. But machine B is going to run only 1 year, 6 months, and within 1 year, 6 months, it is going to generate you 60,000. Now see the difference. If you see the post payback period method, you will conclude that machine B should be purchased. So see how contradictory two
Excuse me, ma.
approaches are.
I
Hmm.
think I have it up.
Yes, please.
This 20,000 plus 40,000, is it equal to 60 or minus 60?
This one,
For my TV, yes.
I cannot hear you. Can you say loudly?
Yeah. What I'm saying is this 20,000 plus 40,000 equals to 60,000,
This
or
one. Okay,
20,000
okay.
plus
Just
40
give me.
minus 60.
Let me explain once again. That we have already came to know that 3 years, 6 months are required to recover the 1,20,000. That is the initial investment. Okay. So here in the
Yes.
fourth year, the total earning is 40,000. Out of that, 6 months earning would be 20,000. Okay. So this 20,000 is needed to recover 1,20,000. So that is why you can see this 1,40,000. Here you can see the division would be 20,000 for 6 months, which is of pre, and another 20,000 would be for post, because the 40,000 is the total earning. So 20,000 is matlab payback period. This 20,000 is falling under the payback period. So rest of 20,000 will be the earning after getting your investment back. So in the fourth year, post earning is 20,000, and fifth year this another 40,000. So total earning would be thus 60,000 here. Am I clear now?
Yes, that is what exactly I wanted to ask. Is it equals to or minus? Because initially you put minus. So I thought it is
Ha,
20 plus
initial
40
investment
minus.
has to be minus. So initial investment was 1,20,000. So the person has to work for 3 years and 6 months to get that 1,20,000 back. So
I
post years.
understand you, ma. I understand.
Okay,
What I
now
was
you
trying to ask
understand.
you is here. Yes, I understand. It is equals to 60, not minus 60.
Yes.
Okay, thank you.
Okay. Any other question at this point? Okay, so this is all
No
about
question, ma.
post
You can
and
carry on.
no questions. Good. So this is all about payback period, pre and post payback period. One more circumstances can be learned under payback period, that is the bailout payback period. Okay. Now what is that bailout payback period? Just I am going to show you with one example. This is known as bailout payback period method. So this method suggested that you don't need to always run a machine or a project for the entire life. Just right now we have studied that here in the first question, the machine was supposed to run for 5 years, and we are calculating how much when we are going to get our investment back, and after getting my investment back, how much earning I am generating, how much time is needed for generating that income. That is all about post and pre payback period. But here the assumption is that I am running the complete machine for till the end of its life, or I am taking over the project for till the end of its life. But it is not true. Always you don't run the project till the end. Sometimes you take decision to sell it out in between, and that is very real. Okay, now, so like let's say you have identified the company, and you agreed to carry forward project A. But after 2 years, you came to know there is a project C, which is more beneficial than project A. So you decided to sell out project A immediately and enter into project C. That is also a possibility. So that is all about bailout payback period, which says that what if in between the life of the project you decide to sell it out, when you should sell it. So this is all about bailout payback period. So let's again read the question very carefully. So the following information are related to project A. Yes, okay. So one project is given. Yes, please.
Excuse me, ma. Your screen is not visible.
Not
Your screen
visible.
is not visible.
Okay.
Yes, ma.
No, it's from your network. It's,
Was it visible?
Raman, it's from your network. It's from your network. It's visible. It's visible.
Okay.
Try disconnecting and connect again, William.
Is it
Okay.
visible now?
All right.
Yes, it's visible. Yes, it's visible.
Yeah, it's visible now.
Okay. So the here we have a question that the following information are related to project A. Okay. Now what are the information are given? The first information is given that the cost of the project is 1,80,000, because your investment is going to be 1,80,000, and after investing 1,80,000, the total life of this project is 10 years, means you can generate earning up to 10 years. And annual cash flow is 30,000, means every year you are going to earn 30,000 rupees, and 30 you are going to earn till 10 years. Now they are also saying that the salvage value at the end of the first year is 1,20,000. If you are going to sell out the project after 1 year, the value would be 1,20,000. Okay. And then annual decrease in the salvage value from the second year onwards is going to be 15,000. And from the next year, if you are trying to sell out the same project, you will be getting 15,000 less than 1,20,000, and so on. So if this is the condition and you are taking a decision to sell out the project when actually you should sell it out, means when your payback period is going to complete, when you are going to receive your 1,80,000 rupees, that is the question. And if that is the question, how to calculate? Let's begin calculating. Okay, so how to calculate? Let's first start preparing the first section. What it would be? It would be the number of years. Okay, so why or year, and how many years the machine is going to earn. according to the question, 10 years. So 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. So 10 years it is going to generate earning. All right. So 10 years, how much earning it is going to generate? So let's write the cash flow. So every year it is going to generate 30,000 rupees according to the question. So 30,000 into 10. Each year it is going to earn the similar money, that is 30,000 rupees. Okay. Now they are also saying ki if you are going to sell it after 1 year, so let's calculate. So the total income at the end of the first year would be this cash flow 30,000 plus 1,20,000. That means 1,50,000, which is less than your investment. Your investment is 1,80,000. So you are going to have a loss if you are ready to sell it after 1 year. What will be the scenario in the next year? To know the scenario in the next year, you need to also include a column in between to calculate the cumulative cash flow here. So in the year first year you are going to earn 30,000. At the end of the next year the earning would be 60,000, then 80,000,
90,
okay, then
120,
1,20,000, and so
180.
on. And talking about the salvage value, at the end of the first year, it is going to be 1,20,000. From the next year, it will be decreased by 15,000. So the next year, the value will be 1,20,000 minus 15,000. That is 1,05,000. Okay. So again, if you are trying to sell out your project after second year, so your earning is going to be 60,000 plus 1,05,000. So the total earning is going to be 1,65,000, which is again less than your investment. At the end of the third year, the total earning from the machine is going to be 90, and here it is again going to be reduced by 15,000. So the total would be 90,000 here. Now you see, if you are making the total 90 plus 90, it is going to 1,80,000, which is equivalent to your investment. See, it is equivalent to your investment. So at least you should run this project for 3 years, then only your payback period will be complete, means you will get your investment back. So after 3 years, it should be your decision whether you would like to continue in the same project, or you would like to sell out the project and enter into any new project. So here you can, as an interpretation, you can write that bailout payback period is 3 years. Means after 3 years, you can sell out the existing project and you can decide to take up a new project. But before 3 years, if you try to sell it out, you won't even get your investment back. So from fourth year onwards, your earning will start. Okay, so this is the scenario which says what if the project is discontinued and it is being sold out in between. So this is going to be the calculation on that case. Is it clear? Is it clear? The bailout payback period? May I know your response? What shall I assume? Is it clear or it is not clear?
We need more explanation about this bailout.
You need more explanation about this bailout. So bailout says that what if you are like, this is the project according to the question, the name of the project is project A, and you need to invest 1,80,000 initially to take up this project, and this project will run for 10 years, and every year it will generate 30,000 earning. Okay, so here I have taken that these are the 10 years and 30,000 every year. The project is going to give you earning 30,000 every year. So that is how, if you calculate, in the first year your earning will be 30,000, in the second year 30 plus 30 60, in the third year 60 plus another 30 90, then fourth year 90 plus another 30 1 lakh 20. If you calculate in the fifth year, it is going to be 1,50,000. Okay, then 1,80,000. If you are continuing still, then another 30,000 will be added, so 1,80,000. Okay, then in the next year 2,10,000, then 2,40,000. This is the earning you are going to get if you are continuing this project for 10 years. All right, now the question is, sorry, the question is, what if you are discontinuing the project and you are trying to sell it out? So the question says, if you are selling the project after 1 year, you will be earning 1,20,000 rupees. Okay, that means you have continued the project for 1 year, you earned 30,000 rupees. After then you sold out your project, so you earned another 1,20,000 rupees. So total earning would be 1,20,000 plus 1,20,000 plus 30,000, and it is 1,50,000. That is the earning at the end of first year. If you continue it in the next year, what will happen? You will generate another 30,000 rupees, so your total earning will be 60,000. Okay, but the question also says, after second year, if you were selling, you are going to get 15,000 less than the previous year. So previous year the selling cost was 1,20,000, now it is going to be 1,05,000, 15,000 less than 1,20,000. So the total earning, if you are ready to sell your project, is going to be 60 plus 1,05,000, that is 1,65,000 together. Similarly, if you are trying to sell it at the end of third year, by that time your earning will be 30 plus 30 plus 30, that is 90,000. And your selling cost of the project is going to be another 90,000. So profit plus selling price together, it is 1,80,000. So bailout payback period says, suppose you would like to sell your project in between its life, then when your investment will come back to you after how many years? So in the first year, you see it is less than 1,80,000 because this is your investment, 1,80,000 rupees. So in the first year, you're getting less than 1,80,000 rupees. So not recommended to sell the project. In the next year also, you are not getting 1,80,000 rupees. So again, not recommended. You will be getting some losses. But at the third year, you can decide to sell it out. At least you are getting your investment back here. So that is why, in which year, if you are selling your project, you are getting your investment back will be your bailout payback period. Am I clear now?
Yes, ma. That's mean if you sell it at first year and second year, you will be at loss.
Yes,
Only
there
after.
would be no loss and no profit. Yeah, before 3 years, if you are trying to sell it out, then there would be a huge loss. So that is not recommended. So even if you are selling the project, you are not earning anything is okay. But if you are not even getting your investment return, it is not suggested to sell at that point. That is the concept of bailout payback period. Okay. Hope this is clear.
Yes, ma. This is clear. Very clear.
Okay. Now the third type of calculation, that is accounting rate of return. Now what accounting rate of return suggests, that you need to get how much, you need to calculate how much you are going to get return from the project by averaging the earning. Okay, so how do we do it? Let's say a project cost is 50,000. If you are investing in a project, the cost is going to be 50,000 and had a scrap value of 10,000. And when this project is become come to an end, the its life come to an end, still you can sell it out in the scrap and you are going to generate 10,000 rupees by selling the scrap. Means from 50,000 investment, 10,000 you are going to get it after its life is over. Its stream of income before depreciation and taxes during the 5 years are 10,000, 12,000, 14,000, 16,000, and 20,000. So they are also telling that after investment of 50,000, it is going to run for 5 years and it is going to earn 10,000, 12,000, 14,000, 16,000, and 20,000 rupees approximately. Now, what would be the actual average income? That is the accounting rate of return. So, what would be the actual average income? I think everybody is aware what is the average income and how to calculate the average income. Do you know how to calculate the averages? Is the total by the number of years? So, here we have income 10,000 plus 12,000 plus 14,000 plus
Was
16,000
15 plus 20.
plus 20,000, and as we are earning it in 5 years, so the number is, total number is 5. So for average we need to divide it, divided by 5. So total number of items has to be the number by which it has to be divided. So let's calculate the average. 10,000 plus 12,000 plus 14,000
76,000.
plus and plus 20,000, 72,000, and divided by 5. So 14,400. Okay. So average income is going to be 14,400. Sorry, 14,400. Now this is the average income. In an average, the company is going to earn 14,400 rupees. But at the same time, if you go through the line, it says its stream of income before depreciation and taxes. Means the company did not provide depreciation and did not provide tax. So you need to provide tax, you need to provide depreciation. There is no choice. So you need to also calculate the value of depreciation per year. So how to calculate the depreciation value per year? There is a formula. So depreciation's formula is your uh, cost of the project minus scrap value divided by the life or in the life in the form of number of years. So this is the formula for depreciation. So as we know, the cost of the machine is 50,000 according to this question. Scrap value is 10,000 and life is 5 years. So 50 minus 10 is 40, 40,000 by 5. So 8,000 is the outcome of depreciation. So after deducting the value of depreciation, what is going to be your income? Your income would be 14,400 minus 8,000, that is 6,400. Now we have already reduced the depreciation. After that you need to reduce the tax. So you need to follow the tax calculation of your own country. In my country the industry tax is 50%. So you need to see the tax rate of your country. According to this particular question also, the tax rate is 50%, because here in India we follow the same industry tax rate. So 50%. Okay, so 50% of 6,400 going to be the half of 6,400, that is 3,200. So the actual average earning would be only 3,200. So average annual income is actually Now see the difference. In the previous questions, we did not take out these factors like how much would be the depreciation, how much would be the tax. We have just seen 30,000 every year we are earning, but we are not reducing the depreciation and tax, which is wrong. Here also we have not taken into consideration depreciation or tax, so which is wrong. But in this method, in accounting rate of return, we are calculating the depreciation and tax, which is the actual correct method, and then only we are identifying the average income, which is 3,200. So while calculating payback period, you should not consider this 14,400 as yearly income. Rather, you should consider 3,200 as your yearly income. That is the accounting rate of return, which says ki you must minus all the aspects, then only you will get the actual income to know. Okay, you need to consider your depreciation, you need to consider your life of the product, and then only you can calculate. Further, there are two more formulas are there in the accounting rate of return. One formula is for average rate of return on initial investment. You should know, that's why I am writing it here. Average rate of return on initial investment. If at all the question is asking you to calculate this, the formula is annual average income divided by initial investment multiplied by 100. This is the formula. If someone asks you calculate the average rate of on return on annual investment, then your formula is, your answer is going to be 3,200 divided by initial investment. So your initial investment is 50,000 for this question, and multiplied by 100. What will be the, whatever would be the answer, it will be in terms of percentage. Okay, and another formula under accounting rate of return is for average rate of return on average investment. I'm just copying the content from here. I hope you all are noting down average investment. So here also the formula will change. Average annual investment by initial investment into 100. So this is the formula. Now further, if you would like to learn what how average annual investment is going to calculate it, So it is all about, okay, I am just writing it again for more clarity. So average annual investment, the formula is initial investment plus scrap value by 2. So average annual investment, if you see for this question, initial investment was 50,000 plus scrap value was 10,000 by 2. So 50,000 plus 10, 60,000 by 2 is 30,000. Now after getting your average annual investment, if you put into the formula, then the formula is going to be 30,000 by 50,000 into 100. The answer will be in form of percentage. So whatever the answer is, that will be in form of percentage. So these are the two formulas you may be asked, so you must know this is all about accounting rate of return, that is the third method. I hope I am clear. Now the fourth method, the method is net present value. I would just like to show you the solved sum because right now there is no time. So I have, give me just a moment so that I can scan from a book and I can show you, as the time is not permitting to show you the entire calculation. So give me a second.
Excuse me,
Yes, please.
I have a question regarding these
Yes,
two
please.
solutions here. According to the first example you gave, yes, this
Yes.
2 divided by 50 times 100 will get 6.4%, while the second one will get 60%. So what is the difference?
In both the percentages, what is the
Yes,
difference?
yes. For the
Okay.
first one, we have 6.4%. The second one will have
Huh.
60%.
Huh. So first one is asking you okay, average rate of return on initial investment. Whatever you have invested, and if you are getting per year 3,200 rupees after investing 50,000 rupees, so what is the profit percentage that you are earning? That is the first question. And the second one is asking ki, let's say your investment and your scrap is together 60,000. So scrap is also a earning, no? Like you are investing 50,000 and after the entire life of the project you are getting your scrap back. So your average investment is actually not 50,000, it is 60,000 because you are foregoing that 10,000 also. And what is the average percentage of investment in the total investment? So that is how the 30,000 is the average investment for the particular year, 2 years, and this is the income. So initial investment, the percentage of profit with the investment, and percentage of total income, including scrap value in the total investment. These two are the differences. I hope I am clear.
Okay, ma'am. Yes, yes, this is clear, ma'am.
Yeah. So net
Thank you.
present value, I am just giving you a quick brief. Net present value, what it says that let's say that you are earning 5,000 rupees today, okay, and with that 5,000 rupees you may able to buy a t-shirt for you. Now let's say you are keeping 5,000 rupees in your pocket and you are thinking that let's wait for some more time, and you spent another 2 years. Okay, now after 2 years will you be able to buy the same t-shirt in 5,000 rupees, or it is going to be more, or it is going to be less? What happens in general? Can you buy the same product in same price after 2 3 years, or its value increases or its value decreases? What happens in general? A general answer. What happens? Can you buy a product in a similar price year after year? Every year you will be getting in the same product in a same price, or the value increases? What happens in general? No answer. Do you know what inflation mean? Do you have an idea what inflation mean? No idea? I hope you do have idea.
Hello, my sorry.
Hmm?
Ma, the question.
Yeah, I am asking, let's say you are buying a certain product in a certain price. Will you be able to get the same product after 3 years in a same price? That is my question. Or it will be costlier, or it will be less costlier. What will happen? That is my question.
Yes, ma. It's depend on the economy of that very country. Some
True,
commodity,
very true,
yes,
very
yes.
true.
Some
So
commodity,
in general, in general in the economy, what do you find? Inflation or deflation?
mostly inflation.
Mostly inflation. So if mostly inflation, that means in most of the cases you will find that the cost increases with the time, isn't
Yes.
it?
Yes, ma. Yes, ma.
And the value of the money decreases with the time. That is why today's 10 rupees may be not enough to buy the same product tomorrow.
Yes,
So the
ma.
price increases and the value of money or the currency decreases with the time, isn't it?
Yes, ma.
Yes,
Yes.
ma.
Yes. So that is why the next calculation of capital budgeting suggests that what will be the effect in the time value of money. So I have no time, that's why I have taken a solve sum for you. This is the question, says that the management of Rekha Company Limited want to invest 20,000 in a project which will give earning for 5 years. Okay? And every year the income is already given here in the year 1 5,000, year 2 10,000, year 3 10,000, year 4 5,000, year 1 year 5 5,000. So if you make a total that how much the project is going to give you the earning, you'll see 5 plus 10 15 plus 10 25 plus 5 30 plus 2,500 32,500 is the total income. But actually if you see the five, if we here as the question says that the economists are expecting an inflation and what will be the rate of inflation, that is not given, but the discounting factor is given 10%, means the value of money is going to be reduced by 10% every year. So that is why at the end of the first year your 1 rupees or currency of 1 is going to be 0.909, which is less than 1. After second year your 1 rupees is going to be 0.826, the value is again reduced. If you see in the third year it is more reduced, it is 0.751. In the fourth year the 1 rupees is going to be valued as 0.683, and in the fifth year the value again will go down by 0.621. This is a tentative information. In most of the countries economy you will see a bit inflation is present in most of the cases, and it is desirable also. Deflation is not desirable. Inflation, a little inflation is always desirable. So whether it is a little inflation or high inflation, your value of money is actually going to be reduced. Means the purchasing power is going to be reduced with the time. So whatever you are earning today in the first year by 5,000, at the end of the year, the value of the 5,000 is going to be 4,545. How did you get this figure? By multiplying 5,000 with the discounting factor 0.909. So you see at the end of the 1 year, your 5,000's actual valuation will be 4,545. Similarly, the value of 10,000 at the second year would be actually 8,560. And that is how, if you calculate, you will see that actual earning is not 32,500, rather the value of money will be on that time, the total the value of 32,500 after 5 years will be actually 25,283. That is the real valuation of money based on the inflation. So that is why in the net present value method, this is net present value method, here we calculate according to the discounting factor, according to the purchasing value of the money, what actually the company is gaining after running the project. So that is why we are not taking the present valuation of money, but we are here taking the future expected value of money. So you can see 5,000 is actually 5,000 multiplied by 0.909, and the actual valuation is 4545. Similarly, in the second year, 10,000 into 0.826 is 8260. Again 10,000, but this time the value is 7510. In the fourth year, 5,000 becomes 3,415, and in the fifth year, 2,500 becomes 1553. So that is why the total earning is 25,823. As the initial investment was 20,000, so that is why net present value, the formula of net present value here I can mention also, if I am able to write. The value of net present value is total minus investment. So total is 25,283 minus the investment is 20,000. So the actual earning of the project is 5,283. Okay. Are you able to understand this?
Yes, we are getting it.
Yes, ma.
Yeah. So this is the way net present value is the very popular method in all the countries to evaluate the project, because it is expected. You cannot say your earning is 32,500 because you are not able to get the same valuation of that money. So you need to always calculate according to the discounting factor. And the last one is the IRR method. So IRR method is nothing but, here I am saying the discounting factor is 10%. But how do I know that the discounting factor is 10%? This is the assumption by the economist. So how the economist actually get into the conclusion that what should be the discounting factor? So that is IRR. So this is not in your syllabus. I thought of explaining this, but because of the constraint of time, I am not explaining. You may go through the internet as it is not required for you. Just a small description that this is this is the investment 10,500, and these are the earnings. First year 2,000, then second year 3,000, the third year 4,000, and the fourth year 5,000. So expected discounting factor will be in between 10% to 12%. Okay, so what the person has done, first they have calculated according to 10% and get the value, then according to 12% and get the value, and then with a formula they try to calculate what should be the actual discounting factor. So it in between 10 to 12 it is 10.84. So how they have calculated, in 10% the answer was 10,715. This is the income. According to 12% the income is 10,205. So this is the result of 10%. This is the result of 12%. So this is known as lower residue. This is known as higher residue. Rest is this formula. So kindly send me the mail ID today also, so that I can forward this file. If you go through the calculation, I think it will be very, very clear to you. And mostly you can also note down that mostly the question which is asked to the examination is difference between the NPV and IRR method, net present value method and IRR method, so that you must always prepare. Okay, so here I am ending my class. Kindly message your mail ID so that I can forward this file to everyone. Would you like to get this file? Then please send me your mail ID so that I can forward this to you. If not needed, then it is okay. Okay, Anas is sending. Okay, Anas, I'm copying your mail ID. Immediately, I will be sending you. Are beneficial for you. I am writing it once again. If you have any confusion at any point of time, you can write. I will try to reply. Okay. Thank you, Anas.
Thank you very much,
That was
Shima.
really interesting. Yes, please.
It was
Thank you so much. I hope this is beneficial, and I wish that I could have taken more classes maybe in the next semester or somewhere. If I get chance, I can if you for your assignment, for your exams, you can always very nice experience for me too. For students who are not from India, so it is a very good experience for me also. Thank you so much. So much. Hope you will perform well in your exam. My LinkedIn ID. Okay, I need to check. I forget actually my LinkedIn ID. I need to see it. Sometime you don't log out. I am just looking at my LinkedIn ID. You can search with my name. It is Sushmita Chaudhary Sen. I hope you will be getting it.
class captain search.
Because yes, please.
No, I'm asking about captain search. Search it again.
Please message in the message box. I'm not able to hear you. In.com, my friend. Okay, okay. You can search with this. I'm getting it actually. Give me 2 minutes time. Yeah, I think I got it. Just I'm sharing with you. Yeah, I got it. Yeah, it's in the chat box. Kindly open and see it whether my profile is visible or not. I think it will be classes and all the very best for your future endeavors and write your and I appreciate point of time when you 15